This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe Rabil with Invest Like a Pro, and today I want to do an example of an intraday swing trade. And just so you guys are aware, if you've been watching the show for any length of time, you know that the examples that I use are pertinent to what the market is doing at the time. So because the volatility is going up, tends to be a better time to be a day trader when volatility is up because you have bigger ranges intraday. When the volatility is dropping, and you're getting more of a steady type of trend action taking place on daily charts and weekly charts, I've noticed that the day trading isn't quite as profitable, and you're doing a lot of work for a lot less money. Whereas right now, it's kind of like you can spend more time doing, you can spend time doing it and make more money than normal periods. So just kind of keep that in mind. I'm not telling you again to be a day trader or anything like that, but just recognizing how the volatility switches and how that can have an effect on what you're trying to do. So if you're a swing trader and the volatility is up, it's very difficult because we get a lot of gaps, and we had another gap down. I'm doing this on Friday for Monday, and another gap down. If you're trying to swing trade, it's really difficult when there's lots of gaps, and that usually coincides when the volatility is up. So anyway, that gives you the reason why I'm probably, for now, as long as the volatility is high, I'm going to do some intraday trades. But I want you to know that the patterns that I'm using apply in all time frames, and there's really very little difference. Maybe some of the profit-taking approaches are a little bit different intraday, but generally speaking, in terms of the overall strategy, very, very similar. So let's go ahead and get into this example. So I've got the spider. I'm going to focus in on the spider because the thing is that every day there are opportunities in the spider. I mean, that's the reality of the situation. It just trades like crazy. The E-mini, S&P E-mini is just an incredibly popular contract. So what I did was, on the left chart, I've got the 10-minute, and on the right chart, I have a 2-minute. And what I decided to put on here to make it simpler is this is the hourly 18. You see how that's declining here? And you notice when we got this drop, and I mentioned on Friday how we had, last Friday, how we had a little divergence here, and we were stretched away, and it ended up being a really minor little trade. And what ended up happening is, instead of rallying up to this line, it just worked sideways. No real sign of buyers in here at all. So what we were looking for are opportunities to kind of take advantage of the rallies towards when we get closer to this line. So the first one that shows up is here, and we can see that based on the fact that the MACD reached up to the 0 line. And we actually have a little bit of a reverse divergence. So this is basically a double top, and this is clearly a higher high. But my main thing is that this is right at the 0 line. So I get a lot of questions about this. So once this rallies up and we're up here, what do you do? I mean, we really don't want to wait for this to cross down for our signal. Look at where that took place. It was way down here. Okay, there's no trade if you wait for this to click in. So what I like to do is I'm going on the smaller time frame, and I'm looking for a reversal pattern to set up. Now, what I'm telling you about this is that these trades are not meant to be trend trades. So when you get in, if you were to get in this somewhere, you're not looking to trail a stop and make a big amount of money. You're trying to get in and get out. It's more, figure out what your risk reward is and try and take a target and try and get there. So if we go over to where this was taking place, that's over here on this part of the chart. So if you notice, when this was rallying up, and it rallied up, pulled back, and went to a new high, and that was when we were at the 0 line. Well, that's right up here. And I would be, because we made a move up, pulled back, made a higher low, and then a higher high. As soon as we make the higher high, I can draw in the trend line. So we had the break of the trend line. Now, we didn't get a 2 in this situation, but look at what we did have. We got this to pinch back up after the 2 minute crossed down through the zero line and we got a little pinch play here. Notice how red DI crossed over and then was holding above green during this rally. So this is actually a really good signal. Let's just zero in on this. I think that's a really good signal. Now, because it was a little far away, if you were to take in this trigger and you're a little far away here, I like to give it a little extra room. Instead of just putting a stop here, I might just give it a little extra, just a little extra distance above, just to make sure I don't get nicked out while this is trying to reach up to the 18. I don't think I'd put the stop all the way up above these moving averages, but maybe if you look at this big bar, you see this big bar here? Go above the midpoint of that. It gives you a little bit more room by putting a stop up here. So just look back at these are different ideas for you guys, because I know you've probably done a pinch play where you got in here and you got nicked out and then it went and did what you thought it would do. So I know in the book I say put it right, a couple cents above. I've actually gotten a little bit more lenient. I like to go back and look for either the last peak or the midpoint of a big bar like that and go above that. Just give it a little extra room. But if you put that on. Now, the other thing you could do is kind of watch this, and you can see where this was actually the key level. 393 was the key level. If you do that, then you can play a pretty tight stop if you kind of wait for this to really get going down through that level. After it tested it, rallied back up, came back down, you had pretty good evidence that this was probably getting ready for the next leg. Now, the main point I wanted to make is that I'm not necessarily looking to get in this and milk this for a big move. I know I've got some support down in here. So I'm watching the bars and I get a monster bar here. I'm probably thinking in this big bar after being in for, either here or here, and all of a sudden I get a pretty good bar here and then a monster bar here. I want to do something, take some profits. But if you do the math, you can get 2-to-1 at going down to this target. So, you're trying to add crumbs to the bottom line when you're doing day trading. It's more of a scalping approach. It's not necessarily trying to get in and trade and hold it all the way down, especially when you're playing counter trend, especially when you got so much volatility, especially when there's signs of support on the higher time frame. So you might be able to live through this and then play this down and play this divergence game, because it does work. You see what happened? We had a move to the downside. It rallied up and made a lower low, and then we got divergence in the DI. See how powerful this is? Then you could put your stop here. You can definitely do that. But what I'm telling you is on the way down, when you get big bars and big movement and you're beyond 1 times your risk, that was about 1.5 times your risk, 1.5, right? Take some, even if you take half there, and then trail the rest and then you start trailing it really tight when we get divergence in red DI, then you can do that. And it turns into a really nice trade. You're in at the latest at 393 and get a move down to 391. That's $2, and you're not risking a dollar in that trade. So, that's the kind of trading I think I'd be more interested in. Now, there was a second one that developed. If you notice, we got another zero line reversal. And again, we're coming closer to this declining 18 on the hourly. What I don't like about this one is the ADX showed that it wasn't getting above 25. So I know if I'm doing this trade, I'm doing it, I can do this trade still, because again, I'm doing it off a 10-minute and a 2-minute. And I know what this is telling me is I have to be ultra nimble. I have to get a trigger, and then I have to be ultra nimble. Now, the same thing happened on this 2-minute. We got a trend line break, and then it formed a little, it wasn't quite as crystal clear, but it was essentially a pinch play. We didn't get two higher lows, but we got a pretty clear look to this pattern. And red DI did kind of come back. This one was pretty strong to the upside based on the ADX. Not as good of a setup, in my opinion, as the prior one. And again, and then you got one big bar to the downside, and we're coming into support. This is a trade that I probably wouldn't have made a whole lot of money in. And I might, because I had such a good trade here, I might not have played this one based on what's taking place. The last thing I'm going to bring up here is that You notice how this was a divergence and then we actually showed more strength to the downside? Well, this can be a climax pattern. When you have divergent highs, so that's a red peak, red peak, red peak, and they're diverging, right? And then you get one more move to the downside that's kind of like a big move to the downside. This can form some kind of a climax pattern. Now, we need price to confirm, and right now price is not confirming. Right now price is rallying up and looks like it's failing. But if we get some sign, maybe drawing a trend line like that, if we get some sign of improvement in price that it gets through maybe the moving average environment on that time frame, then you can sort of assume this was a climax and that we're probably going to get a little bit better rally. Last point I'm going to make here is when we get a big gap down like this, I tend not to be that interested in playing this first rally like this. You see how there's distance between here and the 18 after a gap on an intraday basis. Okay, I'm specifically talking about intraday trades because what I've noticed is you get these rallies up and yeah, you trigger and you get your 1, 2, 3, but I've just noticed that it kind of wobbles around and a lot of times when you get the gaps, they can consolidate a little bit more. And then maybe later on, maybe early this afternoon or late this afternoon, we can get another leg to the downside. Now, I mean, it's possible this will just keep going. I mean, I'm not saying that can't happen. I just, again, I like to play probabilities. And as ugly as this looks and the possibility is to just continue to decline, if you can manage the risk and you feel like you can put on, so if I could do this trade here, and then I get the 1 and then I rally up to the 18. See this setup here? So I rally up and I know I've got a tiny little bar right here and we overran it. So let me just show you this. You see how we have this small bar and we've rallied up right at the 0 line and we have no strength on the buying side. Okay, now we get this move up and it takes it out by a tiny margin. When that comes down through this low, you can do that and use that as your stop. Really tight stop in this situation. And the reason is because of what I'm saying about the gap down and that if this is going to work, it's going to go and it's going to go right now. It's not going to wallow around. I just notice a lot of times when you get a gap down, it'll come down to like the midpoint, about where it is now, and then it'll kind of just drift back up, and it ends up just not being worth it. And since I have little time, I'm really looking for the A+ trades. I'm not saying this is more like a B, maybe B+ potentially. It's not. I'm staying A+ on intradays because I don't have the time to sit around and take every trade. If I'm taking every trade, okay, then I might consider this as a rally up, pinch play, strong ADX to the downside. But I like it to be a little bit closer to the 18. But since I got such a great entry here right at the 0 line, and I know I've got really tight risk, I might be willing to take that trade. So, and then the other thing you could do in this type of situation is so we make this move down and we make a lower low. All right, so I know my stop's here. Now, if we rally up and we come to another lower low, it's really close. It hasn't done it yet. But if this were to go to a lower low, then I can lower the stop to here. You see what's going on? You see how this is finding support at this area? It's right about the midpoint of this decline. And that has to do with the fact that we have this massive gap down. So it's just a harder way to make money. I'm not saying that this thing, I mean, for all I know, in the next 2 minutes, this is going to plunge to the downside. I've just noticed it's a lot more work in this situation to get it to really follow through this quickly. All right, so those are some different ideas from a short-term day trading standpoint, but also the main patterns can be used in all time frames. All right, go ahead and post any questions or comments. Thanks.